Good morning and welcome to the Killik podcast for Friday, the 4th of March. Again, this week it's been about the macroeconomic data, and we're still focusing on that because we're outside of earnings season. We've seen a stabilisation of the ISM numbers that we'd hoped for when we talked about last week, so the market asset prices rose on the back of that. Within that number, we have seen an increased intention to cut jobs, but as jobless claims are at such a low rate, we don't see that as a particularly big problem, but something that we need to continue to watch. Today's a big day for jobs in the US, so we get a non-farm payroll number. We think what people will be focusing on more is the wage inflation number, and here we started to see that tick up. And that's really important for the outlook for the Treasury curve. So as we previously said, for markets to go higher, when we're in the depth of the pessimism in February, that we needed to see stable dollar, stable to rising oil price, and some wage inflation to counteract this deflationary trend that people are concerned about. Clearly, we're getting some of that. We've seen better macro data. And here, the probability of a US rate rise this year has really bounced back. So we're at 93% at the end of the year. We got down to 11% in Feb, and we're back up to 66%. So they're reacting to that better data. Europe, however, is not having better data, and we continue to see a deterioration in those numbers. And therefore, we expect Mario Draghi to not disappoint when he talks on Thursday next week. So the efficacy of central bank policy has really been something the markets have been doubting more recently. So we expect them to come out with a fairly strong statement. If we go back to looking at the Euro stocks since 2012, on the ECB announcement day, we've had a cumulative positive performance of 13.7%. So they're very important days for markets. Clearly, going into this announcement, there are certain sectors that are at risk. So we are concerned about negative interest rates and the impact they have on bank profitability. A 10 basis point cut to the interest rate number would have a negative effect of between 5 and 10% on bank margins. So should they show more sensitivity in that area and look to stimulate in other ways, I think we'll get an ongoing rally in the European bank sector. We remain very sensitive to the divergence in policy that these diverging economic trends are creating. Here's the economic surprise index, Eurozone deteriorating, US improving, and that will put pressure on the US dollar and the trade-weighted US dollar. Renewed strength in this area on a global basis will put more pressure on US dollar priced assets like energy and mining assets and emerging markets. So that area of the market has actually been performing extremely well since the third quarter of last year, and the relative strength there has continued into this year, and we've seen a lot of short covering in those names and quite a bit of sector rotation back into those names on the long side, people who are worrying about underperformance. So we feel that it's a good time to be looking at the stocks where we feel the underlying trend is more entrenched and performed very well last year, but have performed less well over the last quarter. So speak to your broker about those areas. In terms of the week ahead, we've got a relatively light reporting schedule. We have eSure and Volkswagen on Tuesday of the Killik list, Prudential on Wednesday, Cineworld on Thursday, and Lindy on Thursday as well. Thanks for listening. Have a good weekend.